market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the rally in onshore Chinese stocks has cooled as traders questioned Beijing's resolve to add more stimulus. Now, the turnover reached a record as the market reopens from a week-long holiday. So we had a briefing from China's Economic Planning Agency today. Let's get straight to Rebecca Chun-Wilkins with the very latest. Rebecca, why were the markets disappointed?
Well, the briefing today was announced and they said that they would discuss incremental policy, and essentially they delivered exactly what they would say on the tin. However, there was so much expectation that for some reason we were going to get more news, particularly any kind of detail around the stimulus, the actual type of fiscal package that is going to be put behind Beijing's stimulus. And we just didn't see any measures, any new announcements, or any real clarity over, for example, plans to try and boost consumer sentiment. Now, it's no wonder that investor expectations were so high. We've had state media really talking up consumer spending over the Golden Week holidays, which we just have had. We also had discussions about record spending, brokerages working through the holidays in order to meet demand for retail investors to open new accounts. Now, the NDRC typically actually doesn't really have a mandate to deliver new kinds of spending, new packages when it comes to fiscal support. So in some ways, there was a mismatch here between investor expectations and what the NDRC actually can deliver. But part of that also came from policymakers themselves. We've seen an unusual level of urgency behind comments from, for example, the PBOC, from the Politburo, and so on. And that has sort of driven this notion that investors have that they might see more than usual from these types of briefings.
Rebecca, thanks so much. Bloomberg's Rebecca Chun-Wilkins there with the very latest on China. Now joining us for more of a conversation on markets and, of course, everything that's happening also at Treasuries, Patrick Armstrong, Chief Investment Officer and Managing Partner at Plurimi Wealth, and Bloomberg's Justina Lisa. Thank you both for joining us. Patrick, what a day. I mean, so, China's reopening after a week-long holiday. And actually, I don't know whether they worry that, or, markets worry that they're also stimulating the wrong thing. I don't know whether it's because there's not enough stimulus, or you're stimulating the old economy if you continue with these kind of bazookas.
Yeah, it's a bit of many things, because it was a closed period, and then you had a lot of speculative activity in the U.S. that you couldn't follow through with direct positions on in the U.S. or in China. They did announce fiscal and monetary stimulus at the same time, which is very rare a few weeks ago, and the market really rallied on that. The shorts recovered, and taking a bit of a breather until we get some concrete policy that's probably going to drive consumption. So I do expect that's the path of things. But the market has run so far. It's not surprising to me.
Oh, yeah, Justina, I mean, how much of this is also the fact that there's a U.S. election and it seems that it's, China bashing is not going to stop anytime soon?
Yeah, I mean, it definitely seems like the external environment is not becoming more friendly to China. And at the same time, there are a lot of deep structural issues that have been exposed by this property slowdown. So I think for a lot of global investors, where maybe they already renamed their fund, right, from China to Asia, or they're kind of taking even China out of the emerging markets equation, I think bringing that money back is going to take a lot more than a few stimulus pressures. And I'm sure a lot of them are feeling FOMO right now. But I think they're also kind of wondering, with those geopolitical and demographic challenges, and of course, kind of a lot of political difficulty, kind of from the perspective of a lot of, European and American investors. I mean, it's probably going to take a lot more for them to reconsider that market.
Patrick, do you get into these Chinese markets at all at some point?
Not in a big way. So we own some Chinese equities. We own Alibaba. That's the only one we own. But what is spooking me more than the stimulus is what Xi said on the 75th anniversary, is that he made it clear Taiwan's part of China, one people. And that's the kind of sentiment as a foreign investor in China. When that's reiterated, I think that's just as scary as the benefits of the stimulus that he's putting in place.
Patrick, we've had some pretty big moves on treasuries. Did you have to change your calls on how many Fed cuts we get this year?
No, I haven't, but the market started to, I think. And the market did get a bit ahead of itself in terms of pricing Fed cuts. We do think the Fed will be cutting another 25 in the next two meetings, so another 50 this year. But 2025, I do think inflation becomes a problem again. There's a lot of forces that create inflation, basically. You've got Kamala Harris spending too much. You've got Trump cutting taxes too much, putting tariffs, and populism is just an inflationary measure, essentially. And I do think the cuts won't be coming as quickly as the market was pricing and is still pricing for next year.
Patrick, this is your contrarian call, but it's 12 months from now. So you think actually smooth sailing until the end of the year?
I do think so, unless we have a geopolitical event that causes oil prices to spike, which creates short-term inflation. But the path right now is disinflationary, but the policies that are in place and geopolitical events, you can't just say they're fine now, they'll continue to be fine. That's an environment that you do get spikes in inflation. So not persistent, continuous inflation, but intermittent inflation, and you should be positioned for that.
Justina, what's your take on oil? I know there was a lot of fear in the markets about a possible, attack on Iranian oil infrastructure, but actually things have stabilized since.
Yeah, it's kind of interesting that we're finally kind of seeing that big move in oil that I'm sure a lot of people have been worried about this whole year. And it really is a combination of kind of stronger demand in China, but also kind of these supply factors kind of related to all the geopolitical events you just talked about. Now, I think for now, like perhaps it's not such a big economic worry because it's kind of spiking from a pretty low base. But I think if this kind of continues, it would start to factor into, the bigger inflationary picture as well.
What's your call on? I mean, the market is trying to price in a no landing scenario, which again, there are many question marks on what that actually looks like. But does it mean that, there's certain industries or sectors that will benefit?
I have a pro-cyclical positioning in my portfolio. I do think growth continues, and it's driven by a strong U.S. consumer, a fully employed consumer. You've got unemployment down at 4.1%. You've got wage growth at 4%, and inflation is falling right now. So that's power spending. So I do want to have a pro-cyclical stance. Government spending is going to continue to drive the economy forward. So there's a big debt mountain being built up. That's a problem not for this year, but that will become increasingly more of a problem going forward. But right now, economic growth continues.
But Patrick, if you feel like inflation could really spike up in 12 months, do you try and position now to try and have an actual hedge, or does it just mean that
the easiest hedge is you buy U.S. tips? They give you 1.8% real yield on 10 years and 30 years. Whatever inflation is, you grow your purchasing power by almost 2% per annum by buying those. Buying conventional treasuries. As yields have moved higher, we've seen recently over the last month, that can continue to happen as structurally higher inflation gets priced into markets, which that's what policies are going to create. They want inflation. Nominal GDP growth is easier to achieve than real GDP growth, and inflation is a big part of that nominal growth.
And Justina, we're seeing sticky inflation, for example, in services here in the UK. What's your take on when you look at some of the data coming out? Could it come? We also have earnings in the US. Are there any stress points where we could see this creeping up?
Yeah, I think that really is the big question here because we kind of concluded from the jobs report that maybe the labor market is a lot more stronger than we expected. But is this a sign, is kind of the wage growth a sign that inflation is actually kind of stickier than we expected? And I think there's really a big debate right now because even though the labor market report was kind of stronger than expected, some people are saying maybe if you look into the details, maybe the jobs growth was really concentrated in a few sectors. We did see people who were jobless for longer periods of time. I mean, that kind of ticked up. So are we in a situation where maybe jobs growth is already slowing? It's just that people are not firing just yet. And so I think that really is the big question here when it comes to the labor market.
Thank you so much for joining us, Justina Lee there, and Patrick Armstrong from Plurimi Wealth stays with us. Coming up, Samsung says sorry, a mea culpa from Korea's biggest company after its third quarter earnings missed expectations. We have the story next, and this is Bloomberg.
Today, a Bloomberg exclusive with a Wall Street titan. JP Morgan Chairman and CEO Jamie Dimon sits down for an exclusive interview with Bloomberg's Lisa Abramowitz, live from the JP Morgan Techstars Conference in London to discuss the global economy, risks and opportunities around AI, and the U.S. election. Tune in today at 2:30 UK time, 9:30 Eastern, only on Bloomberg Television. Context changes everything. Well,
Well, Samsung shares slipped after its preliminary third quarter earnings missed expectations. The company issued a rare apology for the weak results, an unusual admission that it's grappling with a potential crisis. Well, joining us now, Bloomberg Daybreak Europe anchor Tom McKenzie. So, Tom, good morning. What's wrong with Samsung?
Yeah, and look, Fran, you talked about this being a mea culpa, and it was quite an extraordinary mea culpa from the head of the chips division, the all-important chips division, relatively new to the job. They missed on revenues, they missed on profits, but really fascinating. He actually talked about concerns being voiced around the competitiveness of Samsung, South Korea's biggest company. Also concerns about a crisis at Samsung. That's what he's hearing. He wanted to address that, but clearly there is catch-up that needs to come through for Samsung. And he was pretty clear about this. We are still behind. I'm paraphrasing, but essentially Samsung is behind their competitor SK Hynix when it comes to supplying high bandwidth memory, HBM memory, chips that go alongside NVIDIA's AI accelerators, the GPUs. They go hand in hand, and Samsung has not cracked that market comprehensively yet. SK Hynix has a march on them. They still are waiting for certification, so approval from NVIDIA for their HBMs. They said earlier this year they thought it would have happened by now. That hasn't happened. So there's a delay in supplying those chips to NVIDIA. They need that to come through. They also are not catching up with TSMC when it comes to the contract manufacturing part of the business for Samsung. So two major headwinds. They say they're going to go with an overhaul. The head of the chips division said that, so expect some changes to be pushed through at the company in the next few weeks and months, maybe headcount cuts, maybe reorganisation at the business, but we are waiting for that approval, the certification of that HBM, that high bandwidth memory, to go with NVIDIA.
And so, Tom, what are they saying about AI demand in general?
So Samsung, in terms of the AI demand, they are looking, of course, to compete on that front. Hon Hai, interestingly, because we're getting a rounded out picture today in terms of some of the hardware story when it comes to that AI outlook. When we focus on the demand ROI, are we actually getting that ROI? We're looking at the chips maker, Samsung, in terms of the memory part of this, HBM. Then Hon Hai, of course, the maker of Apple iPhones, but also increasingly the servers that package up those NVIDIA chips that are then sold to the hyperscalers like Meta and Amazon. They are saying they're seeing very strong demand. So their results, they came out with sales numbers that were 20% up. They said it in the third quarter, it was their best quarter on record. The iPhone demand, they manufacture all of the vast majority of the iPhones for Apple, and that seems to be bottoming out. Bloomberg Intelligence says there could be further upside. This is a stock, Hon Hai, is already up about 80% year to date. Bloomberg Intelligence says there could be further to go, particularly when NVIDIA's Blackwell chip, the latest generation of chip, really comes to the market in the last quarter of this year. That will have to be packaged up with Hon Hai servers, so that could propel further demand as well. One headwind, they contract manufacture electric vehicles. We know about that market being soggy. Consumer electronics, so the iPhones seems to be getting better. There's the AI play for Apple that could lead to a pickup in terms of us buying and upgrading around our iPhones. So on two metrics, it's looking relatively positive for Hon Hai. Right. On the EV piece, a little the soggier, but in terms of the AI view from Hon Hai, it's solid still.
Tom, thank you so much. Tom McKenzie there on the very latest with Samsung and Hon Hai. Still with us, Patrick Armstrong from Plurimi. Well, Patrick, when you look at AI, they seem priced to perfection. Is there anything left to buy?
NVIDIA is still the biggest weight in my portfolio. It's up 20% in the last few weeks. But as Tom's just pointed out, NVIDIA is the driver of everything. It's got the most predictable revenues, the most predictable cash flows, the profit margins very strong. And because it's customers, they're inelastic demand. Basically, Microsoft, Apple, Meta, these companies are going to spend. They've got their budgets in place. They're cash rich. So all of those sort of things I don't worry about. The rest of the semiconductors that have really rallied with NVIDIA, I'm more worried about those because I don't think they have the pricing power, and you've got to be part of the NVIDIA ecosystem to really thrive. And if you're not, and if you're trying to compete, it's a tough struggle right now.
Even the big American ones?
I think so, yeah. I think it's just clear that the data center demand is driven by NVIDIA and the ecosystem it's created. So, yes, that's, I think, the pure play you want, even though it has run so far.
Patrick, what else are you interested in at the moment? I know you like defensive stocks, you like energy stocks
rather than defensive. So like military spending.
Military.
Yeah, so defensive stocks I actually don't like. We're actually short Nestle, we're short Estee Lauder. We think those companies don't have the brands and the pricing power they used to have, but defense stocks, unfortunately, it's just a clear path to military spend on NATO spending, replenishing arms that are used, and building up defenses against an increasingly hostile global backdrop.
Energy stocks?
Energy stocks make great sense in a portfolio. They're very cheap. They've paid down debt. They're producing cash flow. We think oil prices at $70 is fair. You've got a bit of a risk premium in oil prices right now, justifiably so. But these companies are incredibly cash flow positive at $70 oil. And if you look at where inventories are, they are as low today as they've been at any time since 2018 right now. So inventories are low in an environment where supply could be curtailed quite easily. So I think you want to own energy stocks in an equity portfolio.
Are you worried about the U.S. earnings season? So it kicks off with some of the banks Thursday, Friday, and margins under pressure?
The banks, we don't have big positions in banks, but I'm not too worried about it. The swing factor is going to come down to trading revenues, which I think is going to be a positive. There's been enough volatility that they should be able to make money on both the bond and equity side of things. And I think that's the incremental surprise you're going to get is really strong trading activities out of the banks. And companies are incredible at driving estimates to meet, just fall below where they're delivering right now. So there's not been anything in the quiet period in terms of consumer demand, economic backdrop that would lead to misses in aggregate, I think. So I do think we'll get an environment of probably 70 to 80% beats this year, or this quarter.
What about luxury? I know they've been taking quite a beating because of the China story. Is there a good time to get back in?
I don't think so. So we're short Kering, and I own Hermes. I think you want to own the companies that have the best brands, that have built up brands, built brand equity, and companies like Kering with its Gucci brand, I think it's almost been neglected. So I do think it's not just a boat that's going to push everything higher. You want to be selective and own the companies that are really delivering higher ROEs and improving their brand value.
Patrick, thanks so much for joining us. Patrick Armstrong, there from Plurimi Wealth. Coming up, fighting continues on multiple fronts a year after Hamas attacks Israel. We'll have the latest from the Middle East next, and this is Bloomberg. Hamas fired a barrage of rockets towards Tel Aviv yesterday, 1 year after the Gaza militant group launched its attacks on Israel. Now, the IDF says it intercepted most of them while Israeli jets carried out heavy bombardment in southern Lebanon. Let's bring in Roz Matheson, Bloomberg's EMEA news director. Roz, there's, of course, Israel, especially yesterday, was really ramping up some of their strikes on Lebanon. What do we know what they're trying to do and actually what the end game is?
Well, it seems to be ever sort of elongated front that Israel is now involved in Lebanon. We know they brought in another division into southwestern Lebanon. That's the first reservist division that's coming in, and that brings the total to 4. And so you can see the front really extending, along the bottom of Lebanon, including possibly the use of the Israeli Navy offshore. They're warning people to stay away from those coastal areas. And so, what Israel says is still a targeted and limited incursion seems to be an ever-increasingly front in South Lebanon for this conflict. And, obviously Israel says what it's trying to do is not just, degrade Hezbollah, but cut off the flow of weapons from other, groups supporting Hezbollah into Lebanon. So they're trying to stop the arms flow, but it's also stopping people being able to leave. There are a lot of people who are trying to flee the area, move into Syria and whatnot, and sort of obviously some of their exit routes are now being cut off, so they're caught there, trying to move north, but with limited options. So with that sort of elongating in Lebanon, we know there's been, renewed fighting in Gaza. As to your point, the question is, what is the end game here? I mean, Israel says its end game is to make sure that Hamas, Hezbollah, these proxy groups of Iran cannot, threaten Israel in the way that Hamas did a year ago. And they're obviously some way from that goal, given the pickup again in fighting that we're seeing in Gaza.
Roz, thank you so much. Roz Matheson there with the very latest, of course, on everything that's happening in the Middle East. Now, Hurricane Milton has exploded into the Atlantic's strongest storm this year, bearing down on Florida as a Category 5 hurricane. Now, Governor Ron DeSantis has declared an emergency, and millions have been ordered to evacuate. The storm will probably make landfall tomorrow, with one estimate suggesting it could cause up to $80 billion in damages and losses. Coming up, China's rally loses steam as traders question Beijing's resolve to add more stimulus. We'll be hearing from Phoenix Kalen from Societe. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. China's rally loses steam. Beijing disappoints investors after holding off on more stimulus. Samsung's apology, the tech giant, posts disappointing results as it fails to keep up with rivals in the AI memory space. And election rhetoric heats up as Harris accuses Trump of playing politics over the hurricane heading for Florida. Now, China's latest steps to revive the housing market seem to have had an immediate impact. Now, during a week-long holiday, the industry reported brisk sales and buyer interest. Joining us now is Phoenix Kalen, head of emerging market research at Societe Generale. Phoenix, thank you so much for coming on. You're one of the utmost experts when it comes to China and China policy. The market today seems really disappointed after a golden week, after, of course, the markets were closed for a week, that they did not get more policy, more bazooka stimulus from China. Are they correct?
No, this was completely the wrong expectations to have coming into today, because this was coming from the Economic Planning Agency. They don't have the power to actually announce new stimulus measures. That's going to come from the Ministry of Finance. And we do expect to see that later this month at the NPC. So it was, I think, quite unreasonable for us to have strong expectations today about what stimulus measures could be announced. They could not be announced.
But Phoenix, so what are you expecting from them? We had a big bazooka, again, that the market had been waiting for. But I guess there's a catch-22, because if you keep on giving, the economy these bazookas, you're stimulating the old economy that China doesn't necessarily want.
Yeah, so I think it has to come down to kind of addressing the structural bottlenecks and deficiencies in the economy around stabilizing consumption. So shifting away from the export-driven kind of story into a more demand-led, consumption-driven story, stabilizing the housing sector, of course, and then stabilizing on the debt deleveraging front of the local governments and doing those fiscal transfers, doing the debt deleveraging on that side to try to solve all of those structural bottlenecks. So I think it has to come from those angles, and it will come, but I think it will come in batches, and we're expecting for those batches to start being announced later this month at the NPC. We're expecting about 2 to 3 trillion RMB worth as an initial tranche, and then for them to make a commitment that they will top up this and expand this into next year, and they'll keep going as long as it takes.
What do you worry about most in the Chinese economy? I know we're also looking at extra tariffs. We don't know who gets into the White House come January 20th. But is there a worry more about real estate? Is it, for example, the youth unemployment that could be higher than the government is letting on?
Yeah, so it's a combination of problems. It's the surging youth unemployment. It's the decline in fiscal revenues as well that's exacerbating the balance sheets of the governments. And then it's the housing problem, which is it's the backbone of the economy. That's really the driver of domestic confidence. So I think addressing that part is very crucial to underpinning the whole economic recovery.
So where do you see growth in GDP in China going, and how crucial are the next steps the policymakers take?
Yeah, so for right now, we're still forecasting for this year growth at 4.8% GDP and then declining to 4.5% next year. So undershooting the targets. We think if they do come out with more aggressive fiscal packages, then that can increase the upside for them to actually meet that 5% type of target over kind of the medium term.
Phoenix, what are the policy that they need to put in place as a priority? Is it supporting households?
It's supporting households. They have announced that they will kind of target the vulnerable populations, the unemployed, youth segments, and so on. It's also stabilizing the housing property prices and property sales. So those volumes have to really be addressed. They have to finish the projects, and that's still a large amount outstanding. That's about 3 to 7 trillion RMB worth that needs to be finished. And then they need to make sure that the inventory can come down from the large cities.
Is there any way that actually China can get closer to the U.S. If they continue supporting Russia to try and, I guess, destigmatize China, but also get, for stronger economic ties, which they probably need?
I guess that's going to really depend a lot on what kind of U.S. administration we see come November. And I think, depending on whether it's a Harris or a Trump administration, we could have a much different stance toward China and in repairing the relationship.
Phoenix, are we underestimating the impact this has on emerging markets in general because of the strong ties, again, to China for some of the commodity rates, some of the also oil producers?
Yeah, I mean, it's difficult to kind of understate the impact that China has on the rest of the world in terms of those very strong ties into Europe, the very strong ties into LATAM, into places like South Africa. All of those commodity angles will have a huge impact and be impacted by what happens to Chinese growth. And so, yes, so much attention on this and the size of the fiscal packages to be announced. And we do expect for those to start being announced later this month.
And will that be enough to shore up confidence?
I think if they keep coming out with promises to deliver and they keep delivering incrementally, even if this is the Chinese way, they're going to take measured steps. They're not going to go all in one big bang bazooka type thing. They will be quite cautious. They've learned a lot from the lessons in 2014, 2015. They don't want to see a repeat of that kind of blow up in the stock market. So they will take their time. And yes, I think over time this will mark a market improvement in the equity outlook and in stabilization of the currency as well.
And can they afford everything that they're trying to put in place?
Yes, I mean, there is still huge scope for the central government to be able to afford extending more help to the local governments and to supporting the households, revive the consumption.
Phoenix, what do markets most misunderstand about China? I mean, there does seem to always be, you know, as especially foreign markets look at China, and as you were saying, they were expecting something today where actually policymakers weren't really able to deliver. But do you think there's a mismatch, really, in expectations?
So talking to investors, there's been such an entrenched kind of mistrust and maybe kind of underestimation of the extent of political will to engage in huge amounts of support. And I think that does come from the fact that, you know, there is a huge concern against moral hazard in places like China and a lot of places within Asia as well. So, yes, there is that concern, and that's legitimate. But I think at this point, we have seen that this time is different, actually. The Chinese policymakers are very much willing to step up and deliver what's needed, but they will deliver it at a measured pace. It won't happen in one go.
Phoenix, thank you so much for joining us. Phoenix Kalen there of Societe Generale. Now, coming up with 4 weeks until Election Day, Kamala Harris and Donald Trump wrap up their media campaigns. We'll discuss their promises, their priorities, and, of course, the potential stumbling blocks. That's next, and this is Bloomberg. Well, Kamala Harris and Donald Trump are ramping up TV appearances 4 weeks out from Election Day in the U.S. As part of her media blitz, Harris appeared on CBS 60 Minutes discussing immigration, the U.S. response to the conflicts in the Middle East and Ukraine, as well as her plans to pay for her economic proposals.
I'm going to make sure that the richest among us who can afford it pay their fair share in taxes. It is not right that teachers and nurses and firefighters are paying a higher tax rate than billionaires and the biggest corporations.
Well, with me now, Stephanie Flanders, Bloomberg's head of economics and government, who also has this fantastic podcast, Voternomics, out Tuesdays and Wednesdays. Stephanie, thank you so much for joining us. So when you look at the candidates in the U.S., how are they polling?
Well, we've had, there's been this sort of extraordinary thing where enormous things have happened in the campaign, and we've all got very excited, not least the withdrawal of President Biden as a candidate, the attempted assassinations on Donald Trump, and yet each time these big things happen, a decisive victory in the debate, in most people's view, for Kamala Harris in September, the polls move maybe a point. And what they talk about as calcification really seems to have happened, that people are you have at least 46, 47% of voters just going to vote for Donald Trump no matter what. A similar percentage saying they're going to vote for Kamala Harris with few margins. And, of course, it's critically those swing state polls that we've been polling every month since the end of last year that are going to make the difference. But it is still remarkably close.
But, Stephanie, I mean, it seems that, Kamala Harris wasn't able to build on her win in the election. Is that because it's not coming across? Is it because they're campaigning differently?
I think, there's some disquiet among Democrats, I would say. I mean, they're very good at panicking, and even when, in retrospect, they were clearly going to win in past election campaigns, this is a period where they start saying, is the candidate doing enough? Do they need to move the dial? I think there was a specific concern with Kamala Harris that she wasn't building on the momentum after the debate. She was still doing even the number of campaign appearances was not as much as they might have expected, just, several times a week rather than several times a day. That has all ratcheted up in the last few days, and you saw that big speech. I would say, the thing that most people said could be fundamental was the way that Kamala Harris has quite consistently increased support on economic issues, or at least narrowed the big gap. One of the ways of looking at this campaign was often, you just take the issue that's most important to voters. The candidate who's got highest polling on that is going to win. And if you've done that at any time, really, in this race, you would say Donald Trump's going to win because people care about the economy and he's favoured on the economy. That gap has narrowed.
But there was there's good employment numbers that came out on Friday. So should that give, again, it feels like Kamala Harris is probably being judged on the incumbent administration because they're Democrats. So that should naturally give her a lift.
You would think so. So you have the big interest rate cut from the Federal Reserve, which obviously Donald Trump was critical of, didn't like the timing. And you've had these good unemployment numbers, the job numbers stronger. We are seeing there's some other things, like it's quite hard to actually get a job at the moment, weirdly. The sort of turnover in the job market is lower. And I think the issue is, even if she's gaining on the economy, and we are seeing her narrowing the gap on all these things, unemployment, concern around taxes, concern around inflation, at the same time you have the Middle East, reminding all of those potential Muslim voters on the Democrat side, but maybe they don't want to vote at all because they don't like either of these candidates. You have the hurricane in North Carolina also kind of just confusing things, raising questions even about the ability for people to vote in parts of North Carolina. So I think that's what got quite a lot of Democrats nervous and makes Donald Trump still look like he's maybe more likely than not to win.
So what are the candidates doing in the next 4 weeks? It feels like they're speaking more to social influencers or podcasts than they are these big rallies.
Yeah, everybody they can, I think, is the answer. And even in the next day, you mentioned that Kamala Harris has done the CBS 60 Minutes. That's her arguably the sort of most serious mainstream network interview she's done. She's done one short one for CNN. But she has mainly been doing social media. She's doing she's doing several more today of different kinds of TV, Hispanic channels, which, as we know, that's one of the other big issues. Although she's doing better with the Latino vote than Joe Biden was, still much lower than in 2020 or even 2016 in some cases. So you see people doing this narrow casting, trying to catch people wherever they can, because those crucial, even maybe tens of thousands of voters could make the difference.
But does that make a difference in the swing states? So if there's 300,000 people that they need to convince in those 6 swing states, do these big media blitzes actually help?
Well, I guess we're going to find out. I mean, I think that it is true that this is people have talked about that the Democrats' kind of quote-unquote ground game, the fact they have a lot more party offices on the ground, that they can be going out, getting out the vote in a way that arguably, well, the Trump campaign has people, but they're kind of paying people to do that. We'll see whether that ends up making a difference. But I think with some of these crucial voters, in Michigan, for example, the Muslim vote, I think with everything that's going on, she spoke to them yesterday. Kamala Harris spoke to a group of voters in Michigan. If they just stay at home, then all these efforts will not help her win that absolutely must-win state.
Stephanie, we have a great big take on today, which everyone can go read on NI Big Take, which basically talks about trades and tariffs, and economists know that there's no winning in tariffs, so we kind of break it down and look at 2 states in particular. Does that feed across the American voter?
Well, it's interesting. I do recommend people to read that piece. It's a detailed read, but part of the message of it is this stuff is really complicated, and if you think there's going to be an easy winner and loser from a tariff, you're very much mistaken. Turned out that the target of the original target that the US company was trying to hit by lobbying for these tariffs ended up getting tariffs put on that other American company. So you never know where they're going to go. We have seen in that swing state poll that actually the tariffs are not so popular among voters, and there's more support for some of Donald Trump's other ideas. For example, no tax on tips and no tax on social security. So I think there is a sense in which people are understanding that tariffs are a mixed blessing and certainly could be described as taxes on consumers.
Stephanie, last week you had this wonderful interview with Emmanuel Macron where he very lucidly actually explains, some of the end games of what the U.S. election means for allies, including Europe. Here he is.
Europe is no more the top priority of the US. The US top priority is US, which is normal and fair. The second top priority is China. And for the rest, it depends on the moment.
So where does it leave allies?
Yeah, I think he's highlighting something which is completely true, that under either a President Harris or a President Trump, the US is going to be, to some extent, pivoting away from Europe. You have the war in Ukraine, and obviously whether or not President Trump wins is going to make a big difference to the US approach to that. But fundamentally, that pivot to Asia, which President Obama sort of tried to do, found it very difficult to do, kept on getting sucked into Europe. That is now well underway, and all of the focus is on China. And at that event, that global dialogue in Berlin, I think that was a question that a lot of people were raising. President Macron was lucid, as he says, on the subject of, where does that leave Europe? And not very many clear answers coming from other parts of Europe.
But how are we getting ready for the day after the U.S. elections? I know we heard yesterday from the Arizona governor saying, look, they worry about chaos after, or even the day of the election. They're putting extra security, like iron fences, cameras. How does this play out?
Yeah, and I actually, in New York the other day, did an interview with the Deputy Attorney General, who is Lisa Monaco, who is already, the Attorney General's office is already fielding a lot of legal cases being put largely by local Republican parties, actually both sides, already saying that there's going to be irregularities, because then it's sort of easier to go to follow those cases if you decide you want to do it after the election. We've had consistently in our swing state poll a majority of voters expecting some kind of violence around the election, which is obviously deeply troubling. And particularly some of the rules changes in places like Georgia, which could even prevent the vote from being certified, I think have us all, we are definitely on watch for that. We have got preparations for that, which we would not have had in a normal election.
Stephanie, thank you so much for joining us today. A lot to think about. Stephanie Flanders, Bloomberg's head of economics and government, of course, a host of our Votonomics podcast. Now, coming up, how two flagship tax-raising plans could end up costing the UK government. More on the Chancellor's big budget next, and this is Bloomberg.
Our economic model is not broken, but we have lost competitiveness for about a decade. And so we are introducing supply-side measures to return to growth.
That was Germany's Finance Minister Christian Lindner speaking ahead of a Eurogroup meeting yesterday. Now, to the UK, and Bloomberg has learned that two of the new government's flagship tax-raising plans are under review ahead of the upcoming budget. Now, we understand that internal Treasury analysis suggests that policies could actually end up costing the exchequer money. Well, Phil Aldrich, our senior economics reporter, joins us with the very latest. So, Phil, when you look at Treasury, they're basically reviewing non-dom carried interest policies. Why?
Obviously there's been some analysis of the dynamic effects of the taxes, so that would be people leaving, so wealthy people leaving. And so as a result, the analysis now shows potentially that you actually get less revenue than you were expecting. Well, you were expecting to get some revenue, may actually lose the revenue. So and sort of effectively deterring wealth creators from staying in the UK. So it's doesn't look like a smart policy.
Right. I mean, it seems like it's been all over the place, right? They've been in charge for like 100 days. Was there a messaging problem, or is it just really a money problem?
I think, the analysis that the Labour did before the election would have been, that it wouldn't have been as rigorously tested as, within the Treasury they would do, or within the Office for Budget Responsibility. And so they had these policies. It's not that they're scrapped. So it's the non-dom arrangement. So it looks like there's going to be small alterations around the edges, not like ripping up the whole policy. I mean, obviously the Tories already used it, and then issues around private equity, which carried interest. Which again, it's not that the whole policy is going to be scrapped. It's about small amounts. I mean, these are ultimately got hundreds of millions of pounds, which which they had hoped to get, but they probably won't get.
So is this? Is she facing like a new fiscal hole?
It's not. I mean, it obviously doesn't help because she's already kind of pledged some of this money to NHS spending, but so they've got to find the extra hundreds of millions that seems to have disappeared. But it doesn't help when you've already got a 16 billion hole that you're trying to fill just from that spending audit back in July.
So they'll have to get creative. So one of my favourite stories today, which is a story that you broke, is that they're also thinking about an exit tax. What is an exit tax?
Well, I'm not sure if they are necessarily thinking about it, but basically there's a bunch of think tanks who are suggesting that they do think about it. But the exit tax is when people, so it's UK domiciled wealthy individuals leaving the UK, and there are strict definitions about what's leaving. You have to be out of the country for several years, and then they will apply CGT onto the gains of your assets between the time that you came to the UK and the date that you left, so that you're unable to. So it's about to stop tax leakage. So you're unable to just take your asset overseas to a tax haven and basically crystallise the gains without paying any tax. And the vast majority of the income, because they estimate, this paper by that came out suggests that about £500 million a year could be raised in this tax. And actually, some tax experts seem to prefer it to just straight up CGT because it's taxed at the CGT rate. And other countries are doing it. Across the G7, only Italy is the only other country that doesn't do it. The US, Australia, Canada, so it's quite a broadly used way of capturing capital gains from wealthy people when they leave.
So interesting. Phil, thank you so much. Bloomberg's Phil Aldrich, they're on the very latest on this make-or-break budget on October 30th. Later today, we'll also speak exclusively with the JP Morgan chairman and chief executive, Jamie Dimon, at the bank's Techstars conference to discuss AI investments, the U.S. election, and more. That conversation with Lisa at 2:30 p.m. London time. Up next, Bloomberg Brief. Vonnie Quinn in New York, Manus Krani in Dubai, and this is Bloomberg.